There is a number that most people over 50 never sit down and calculate, and it is not their retirement savings and it is not their net worth either. It is the amount of money they have quietly lost over the last 5 years without even realizing it was slipping away. I'm not talking about the stock market crashing or inflation eating away at your purchasing power. I am talking about financial decisions that feel completely reasonable in the moment, but slowly drain everything you have spent decades building. Some of these traps look like smart moves, and some of them look like generosity, and a few of them even look like love itself. But they all share one thing in common, and that is they are almost invisible until the damage is already done and it is too late to reverse it. Today, we're going to walk through the money traps that quietly destroy people after 50. And the reason nobody warns you is because most of the people around you are falling into the exact same ones. Here's what happens to a lot of people once they reach their 50s and start settling into the life they built over 2 decades of hard work. They've spent their 30s and 40s building a lifestyle that matched a growing income, with a bigger house and a nicer car and better vacations every single year. None of that felt reckless because the money kept coming in, and every upgrade felt earned and deserved. But then something quietly shifts, and maybe the raises slow down, or the industry changes, or health costs start creeping in a little more each year. The income flattens or even dips, but the lifestyle does not adjust at all, and everything stays exactly the same as it was during the peak earning years. This is what financial planners call lifestyle inertia, and it is one of the most common wealth destroyers that hits people after 50. The trap is not that you're living some extravagant life that anyone would call reckless. The trap is that you're living the same way you did 5 years ago, while the math underneath your financial life has completely changed without you noticing. Because nothing feels different day to day, you never stop to recalculate whether your spending still makes sense. People in their 30s can outrun bad spending habits because they have decades ahead of them, but people in their 50s cannot. The runway is shorter and the margin for error is razor thin, which means even small miscalculations can snowball into serious problems over time. This next one is going to hit close to home for a lot of people watching this right now. Somewhere in your 50s, you become the person everyone turns to whenever they need financial help. Your adult children need help with a down payment, and your aging parents need support with medical bills. A sibling is going through a rough stretch, and because you spent 30 years being responsible with money, you're the one with something to give. So you give, and then you give again, and you tell yourself it's only temporary. But here's the math that nobody talks about openly. Every dollar you give away after 50 carries a multiplied cost, because that dollar no longer has 20 or 30 years to compound and grow. A $10,000 gift at the age of 52 could have grown into more than $30,000 by the time you reach retirement. And if you do that 3 or 4 times over a decade, you have quietly erased a six-figure chunk of your own financial future without realizing it. I am not saying never help your family, because that's not the point. But there's a real difference between generosity and financial self-destruction, and the line between the two is a budget that puts your own retirement needs first. If you would never take a loan against your future self to give to a stranger, then think carefully before doing it for anyone else without a solid plan in place. This next one is counterintuitive because for most of your life you were told that a mortgage is good debt. And in your 30s, that was probably true because you had decades of income ahead of you and the interest was working in the context of a long financial timeline. But carrying a large mortgage into your 60s is a completely different equation that most people do not stop to think through. Here is why that matters so much. When you're working, a mortgage payment is just a line item in your monthly budget that you handle alongside everything else. But when you retire, that same payment becomes a percentage of a fixed and shrinking pool of money that has to last you for the rest of your life. It goes from manageable to suffocating almost overnight, and most people do not see that shift coming until it is already happening. And yet millions of people in their 50s refinance into brand new 30-year mortgages without thinking about what that really means. They do cash-out refinances to fund home renovations or consolidate other debts, and they restart the clock at 53, which means they are now on the hook until 83. The math on this is brutal, and it deserves your full attention. If you refinance $200,000 at 6% interest for 30 years, you will end up paying over $231,000 in interest alone over the life of that loan. That is more than the value of the house itself, and you are paying all of it during the exact years when you should be building a financial cushion, not servicing more debt. The goal after 50 should be reducing your fixed monthly obligations, not extending them further into the future. Every dollar that is locked into a monthly payment is a dollar you cannot redirect when life throws something unexpected at you, and after 50, life tends to throw a lot. This is the panic trap, and it usually starts with a single terrifying moment of realization. You look at your retirement savings, and the number staring back at you is nowhere near where it should be. Maybe you started saving late, or maybe you went through a divorce that cut your assets in half, or maybe the last recession hit harder than you expected. Whatever the reason, the gap between where you are and where you need to be feels enormous and overwhelming. So you start looking for shortcuts to close that gap as quickly as possible. Crypto and options trading and a friend of a friend with a real estate deal that promises 15% returns start to look very appealing. And the logic feels sound because you tell yourself that you need to make up for lost time, and you need bigger returns, and you need to be more aggressive. But here's what that logic completely misses. When you're 25 and you lose 50% of your portfolio, you have 40 years to recover from that loss. When you're 55 and you lose 50% of your portfolio, you may never fully recover because the math simply does not work the same way in both directions. This is called sequence of returns risk, and it is the silent killer of late-stage retirement plans that almost nobody talks about. A major investment loss in your 50s does not just set you back temporarily, it can permanently change what your retirement looks like for the rest of your life. The smarter move is not placing bigger bets, but instead doing a realistic reassessment of where you actually stand. Adjust your timeline and adjust your expectations and maximize your catch-up contributions, which now allow an extra $8,000 per year into your 401k after 50. And if you're between 60 and 63, you can take advantage of the super catch-up, which lets you put in an additional $11,250 per year. Boring and steady wins the race when the finish line is this close and the stakes are this high. Most people in their 50s have a general idea of what they will need for retirement, but almost none of them have accurately priced in the true cost of health care. Here is a number that should stop you in your tracks and get your full attention right now. According to Fidelity, the average couple retiring today at 65 will need approximately $345,000 just for medical expenses throughout retirement. That is not a worst-case scenario or some extreme projection that only applies to unhealthy people. That is the average, and it does not even include long-term care. If you or your partner end up needing assisted living or nursing home care at some point, you are looking at an additional $75,000 to over $130,000 per year, depending on where you live and how long the care lasts. The trap is not that these costs exist, because they've always existed in some form. The trap is that most people do not plan for them until they're already happening and the bills are already piling up. They assume Medicare will cover everything, but it does not cover nearly as much as most people think. They assume their savings will stretch far enough, but in most cases, those savings run out faster than expected. If you're in your 50s right now, the single most important financial move you can make is to get a realistic healthcare cost estimate built into your retirement plan today. Not when you turn 63, and not when something goes wrong and you're scrambling to figure it out. The earlier you plan for this, the less painful and the less disruptive it will be to your overall financial picture. This is the quietest trap of all, and it might actually be the most dangerous one on this entire list. You have a 401k from 2 jobs ago that you never rolled over into your current account. You have an old life insurance policy that you're not even sure is still active or still relevant to your current situation. You have no will, or you have one from 15 years ago that no longer reflects your life as it is today. Your beneficiary designations on your retirement accounts are outdated, and you have no power of attorney document on file. None of these things feel urgent on any given day, and that's exactly what makes them so dangerous. Because the moment any one of them becomes urgent, it's usually too late to fix it properly, and the consequences fall on your family. Getting your financial life organized after 50 is not about being paranoid or morbid about the future. It's about making sure that 30 years of hard work actually ends up going exactly where you want it to go. Not to probate courts, and not to the wrong beneficiary, and not to taxes that could have been avoided entirely with a little bit of planning. One weekend is all it takes to consolidate your retirement accounts and update your will and check your beneficiaries and make sure your family is protected instead of scrambling if something unexpected happens. Here's what I want you to take away from everything we covered today. None of these traps are dramatic, and none of them happen all at once in some obvious way. They don't look like financial disasters from the outside because they look like normal, everyday life. And that's exactly what makes them so effective at quietly erasing everything you've worked for over the course of your entire career. But the good news is that every single one of them is fixable starting right now. Not with some complicated strategy or some expensive financial product, but with awareness and a willingness to look at the numbers honestly.